So let's think about the characteristics of the following different types of securities, whether or not the market requires high search costs, meaning it's very difficult to find a seller if I'm a buyer or a buyer if I'm a seller, liquidity, which is related to search costs, but how much of a price drop I'm going to have to take, and then the information asymmetry. How much information is there, difference between the buyers and the sellers? And then let's think about the different types of markets in which these can fall: direct search, broker, dealer, or continuous auction. And remember, direct search is where the buyers and sellers find each other through some sort of billboard. A broker is where people are paid a commission to find trading partners. A dealer actually takes possession of the asset and then waits for a seller, a buyer to sell to. And a continuous auction is when many buyers and many sellers meet, kind of like in a direct search, except they are constantly placing orders. And we'll talk a lot more about continuous auction in a minute. So what kind of market do stocks fall into? Well, it's often very easy to find a seller, so there aren't a lot of search costs. Stocks are relatively liquid. In fact, they're very liquid, not as liquid as certain other assets, but very liquid. And there isn't a lot of information asymmetry because information regarding stocks is public. And remember, when we talk about information asymmetry, we talk about not whether or not I bothered to do the research, but whether or not I could have done the research. And so what you know about Apple stock is what I could know about Apple stock. And so there isn't high information asymmetry. And so we see stocks trading in continuous auction markets for the most part. But really tiny stocks, penny stocks, well, now I have higher search costs, I have higher liquidity issues. And because these stocks are so small, there may be some information asymmetry issues. And so these don't trade in continuous auction anymore. These trade either in dealer markets, in some situations, but also in broker markets. Usually dealer markets is how penny stocks trade. Treasury bonds. Well, treasury bonds have very low search costs. There's always buyers and sellers. They're very liquid, and there is not a lot of information asymmetry because information regarding what's going to happen in interest rates going forward is public information. And so treasury bonds are going to trade in continuous auction markets. The next are corporate bonds. Now, corporate bonds, there's a lot of corporate bonds out there. There are many issuers of corporate bonds, probably around 10,000 issuers of corporate bonds, and then each is going to have an average of 4 bonds. So there's going to be 40,000 bonds out there. And so to find a buyer for a specific bond, or a seller for a buyer for a specific bond if I want to sell it, or someone who's going to sell me a specific bond if I want to buy it, can be very difficult. In addition, these aren't very liquid. The information asymmetry is likely low, and so these corporate bonds are in dealer markets, and so we see dealer markets for corporate bonds. Muni bonds, same issue with corporate bonds, except amplified. There are probably 50,000 issuers of muni bonds and probably 1 million separate bonds out there. And so muni bonds have very high search costs, very low liquidity. And because there are so many issuers, there's actually more information asymmetry. For example, it's difficult for me to know every single thing about every single school board in the state of Colorado. And so we also see muni bonds trade in dealer markets as well. Commodities trade in broker markets. Brokers will transact in commodities, but commodity derivatives, because it is a centralized market, trade in this continuous auction. And of course, houses trade with brokers. And I've added in the market types for each of these different types of securities. Let's just talk quickly about trading costs. We have 2 types of trading costs. We have direct trading costs, which are commissions. This is a fee that is charged to you by a broker or a dealer. And then we have the spread, and the spread is the difference between the price you can pay for a security and the price you can sell the security. And so in our car example, you would pay $22,000, you would sell for $18,000, the spread would be $4,000. And so if I were to immediately buy the car for $22,000 and then sell it for $18,000, I would lose $4,000. And so this is the spread. And the difference between the bid and the ask, the difference between the price you can pay for a security, which is referred to as the ask, and the price that You can sell a security, or what someone will pay you is the bid. The difference between them is called the bid-ask spread, and the difference between them is a very important measure of liquidity. And what we're going to do now is we're going to look at continuous auction markets. We're going to look at different types of orders and talk about the spread.